evening and welcome to The Money Show, the only daily show of its kind which brings you the market's top financial experts to answer all of your financial queries. I'm Avni Raja. We've got lots lined up for you today. But first, let's take a quick look at the headlines. And Avan Dubash with me. Hi, Avan.
Hi, Avni. Yes, we've got lots lined up today on the show. Let's start off with the top stories. And the member panel on the new direct tax law, Rajiv Memani speaks to ET now after the government sets up a task force to draft a new law to replace the existing IT Act. He believes that the revamped laws will improve compliance and help in widening the tax base.
India Inc. learns to loosen its purse strings while the Nilkenis come together for the first time on Indian television to explain the rationale behind joining the Giving Pledge movement. The Bharti family pledges 10% of personal wealth to philanthropy.
Meantime, LIC could play a crucial role in helping the government raise funds to recapitalize PSU banks. However, sources suggest that the IRDAI has stepped in to vet the insurer's proposal and wants to ensure that policyholders' long-term interests are approved or protected, rather.
Right now, while the government looks to overhaul the direct tax law, Rajiv Memani, a member of the task force, spoke to ET Now on what the panel's mandate is. Listen in.
I think a couple of things. One is, we have the government is very clear in the way the terms of reference has been laid out, what the objective is, and I think this is in line with the various reforms that are being done to enhance the competitiveness of India. And I think also if you look at the composition of the committee, it's under the chairmanship of Shri Arvind Modi. He has obviously had experience both in terms of economic policy and tax, and also has done a lot of work with the earlier direct tax code. So given all that and given the composition of the other committee members, I'm sure we will be able to incorporate what is in the economic interest of the country, some of the best practices around the world, and most importantly, the feedback and the inputs from all the stakeholders involved.
Okay, that's a view coming in, and in fact, let's bring on board an expert to add a little more perspective into the overhauling of the country's direct tax code. We have Frank D'Souza, his partner PwC, joining in. Thank you for being with us. Now, finally, a reboot of the 56-year-old Act. What do you think should be some of the key factors that should be the focal point for the direct tax code draft?
Right. So now, whether it will be called a direct tax code or something else, we can keep that open. But clearly, I think, and as Rajiv also mentioned in his comment out there, tax does have a significant impact in terms of business and competitiveness in terms of a particular economy or jurisdiction. And if you look at what the U.S. and to some extent UK have done in the recent past, and US is trying to do, is use tax as a policy measure to make the business environment competitive in that particular country. It is debatable whether structural changes are best achieved through tinkering with existing law, which has significant jurisprudence for taxpayers to guide them, or whether a whole new approach is required. And at times, at least I believe, when business ecosystem has evolved at the level that it has and will continue to evolve at a more rapid pace, it may be good to have a fresh zero-based look in terms of what the tax law should look at. 2-3 elements that I would just like to see myself in terms of what the committee basically puts out. We need to be alive to the reality that Indian businesses are going to play a more dominant role not only in India but even globally. So if you look at our existing tax law, it was written for a particular ecosystem where you had investment coming in and there was not that much of outbound investment which was taking place. But with Indian businesses finding their place in the global economic framework, where you would have and where you already see, and you should expect more of that to happen, where Indian businesses goes overseas to be able to compete in overseas market, what is it that we can provide for them in the Indian tax context to make that journey competitive as far as they are concerned. And beyond that, the whole issue in terms of transparency, and not only in India but globally, the emphasis which is being placed on that. We do hear about what BEPS has been doing, the level of reporting which has to go in. Recently, we have seen changes in our law, the current law in respect of POEM and GAR. Many of those, I would imagine, would carry over even under the new law. But largely, I expect that it will recognize the changed business environment and the fact that we need to be now looking at tax as a policy where we can make it competitive for businesses, one, to come in and work in our ecosystem, and for Indian companies to be able to go out.
Mr. D'Souza, I would like you to help us, put a little more perspective, and if you can elaborate a little more on what, in your view, can we expect or should really look at the entire DTC would look at in terms of the individual taxpayers and how that could perhaps change going forward with this?
Look, if you look at from an individual taxation perspective, and if you really look at the tax rates that we have, they're not that high as compared to many of the countries. I think they are reasonably, in line in terms of what you would expect in most developed and developing economies. What one could look at in terms of how can the thresholds for the rates to kick in, how they can improve. But that's really not a function of the law, but that's a function of the budget, which will on year basis try to address that. I think the far greater issue as far as individual taxation is concerned is how can you get and how will you ensure that greater amount of people fulfill their obligations in terms of tax payment and reporting. I think the thing that we are struggling with in India is not the fact that the tax rates are high, is really the sheer amount of non-compliance in terms of how many people actually do report their income to tax. Beyond that, from time to time, there would be measures which will encourage certain level of behavior from the taxpayers. So if you want to boost the housing sector, you might potentially give some benefit in that respect. If you want to advance some other kind of objectives of the government, you might give some boost in terms of deductions or benefit on that. But that is more from an annual basis in terms of what the objectives may be. But the more important part here is to acknowledge in terms of what the government can do in law.
Right, Mr. D'Souza, on the flip side, there's the reduction of tax as well, gradually from 30% to 25% level. Is that something that you would want to see as well?
That is something which I think definitely the government will carry through in the new law, because that is a policy statement. I think they'll adhere to it. The change in the law in itself is not going to impede on that or obstruct that in any manner.
To go on that note, appreciate you taking the time out and making, giving us a sense as to what exactly this overhaul of the direct tax code could potentially mean. But let's move on then and bring on board our guests for today who will be helping out with all your queries. Poonam Rungta, Certified Financial Planner and CEO of LP Business School, is with us in the studios. And thank you so much for taking time out and joining in. Poonam, I would like to start off with a topic that, we do increasingly get quite a few queries on, and that is planning for retirement. And most of the experts that we speak to said it's never too early to start. Would you agree?
In fact, I would say that when we are making a financial plan of an individual, retirement planning should be the most important part of the financial planning, because in our country, we don't really look upon it as of now as an important goal. If you look at the past and you see the demographic changes of the society, we are now moving towards the nuclear and the smaller nuclear families. So everybody should plan for their retirement right from the day they start earning their income, so that they have a longer time available to plan for their retirement, which is ultimately going to come, and ultimately you are going to need expenses to go through a retirement period which can be much longer due to the increased healthcare and the other facilities available in that area. So the longer the retirement period, so the longer the money required for it, hence everybody should plan right from the day they start earning for their retirement, which can be done in a very, very progressive manner and very effective manner, and everybody can retire wealthy, you know, if retirement planning is properly done.
Absolutely, extremely important to start as early as possible when it comes to retirement planning. But let's get to our query that's coming in from Saurabh Gupta, who says, I'm currently investing 47,000 in SIP since the last 2 years. Should I continue with this portfolio for the next 20 years? Please review my portfolio. And his portfolio, just quickly recap that. It's DSP BlackRock Microcap Fund, Mirae Assets India Opportunities Fund, Mirae Asset Blue Chip Fund, Franklin India Smaller Companies Fund, Reliance Small Cap, and HDFC Balanced Fund. So this is his entire portfolio. What would be your recommendation as far as his funds are concerned? Would you, recommend that he exit any of them and replace them? What would be your?
See, first of all, we need to understand the objective for which the SIP has been started initially. According to the time horizon for the goal for which you have earmarked an SIP, we should be choosing the right category of fund which you have chosen. Longer the horizon, longer the period available to do SIP, we choose the aggressive funds. So here, if you see the portfolio and giving the time which is sent is 20 years horizon available, we choose the most aggressive funds available. So if you go through this portfolio, there are 3 very aggressive funds of small cap category, which is DSP micro cap, which is giving excellent returns in the past. So is Reliance Small Cap and Franklin Smaller Company. Now all these 3 funds are of the same category. So the diversification in small categories is not happening, but nevertheless, because the time horizon is long, I would say you can continue in all of these 3. In fact, DSP microcap plan doesn't even allow entry anymore. So those who are invested should stay invested in that fund. Now, if you go on to the other funds, which is Mirae Asset Indian Opportunity, which is a diversified category fund, but has more of exposure towards the large caps, and HDFC Balance is a hybrid fund, and Mirae Asset itself is a blue chip fund. So again, the next 3 funds are having the more or less little conservative approach. But if the horizon is longer, you should shift some from them, discontinue probably HDFC Balance, and you can instead of Mirae Asset Opportunity, you can look at more better returns giving diversified fund. But if you are comfortable with these funds and time horizon is long, you can continue, but keep a close view and keep reviewing the portfolio.
That's very important to keep reviewing the portfolio, get in a mix of different kinds of funds. You had Poonam as well advise you as to what should be your allocation to various types, such as large caps as well as different category and themed funds. But it's good to invest in small cap funds as well, she said, for the long-term time horizon. I hope we were able to answer your query, Saurabh. On that note, we'll take a quick break right here on the show, but we have a special show coming up tomorrow. That's the 24th of November at 5:30 p.m. on The Money Show. We talk to you about how you can protect yourself from debit and credit card frauds. So find out all the answers. A change in guest. We have Mr. Rungta. He's personal finance expert now. He will be joining in to give us his expert views on the same. If you have any questions or queries regarding debit and credit card fraud, please reach out to us on The Money Show at etnow.tv. Tomorrow is when we will get them answered.
Welcome back. You are watching The Money Show, and we have with us Poonam Rungta with the studio to answer all of your queries. Well, let's get on to our next query. It's Chandrika Menon who sent us an email saying, please review my portfolio and advise whether or not I should stay invested. And her portfolio includes DSP BlackRock India Tiger Fund, HSBC Equity Fund, and Sundaram Infrastructure Fund. So, Poonam, what would be your recommendation as far as her portfolio is concerned and the funds specifically that she's invested in?
See, primarily one should understand when they are making a portfolio of SIPs that it is spread across various categories of funds to get the proper exposure of the market. Of course, one's own interest levels and conviction matters, and also the time horizon. But here if you say that see the DSP BlackRock Tiger Fund and Sundaram Infrastructure Fund, both are having the same theme for investment, that is the infrastructure theme. So the diversification is not properly happening, and also the theme funds are having little concentrated approach towards the investment strategies of the fund houses. So theme fund should be very carefully selected, and having 2 theme funds in the portfolio can be little risky. So I would suggest that continue only in one theme fund, because both the theme funds are good. You can choose any one out of the 2, and HSBC Equity Fund is a large cap equity fund. So you can have a better fund instead of HSBC, which would be Aditya Birla Frontline Equity, or maybe SBI Blue Chip Fund, which has given better returns in the past. So you can do little shuffling in your portfolio and be invested for a long term in these 2 kind of funds.
And you're advising a shift to Aditya Birla Sun Life Equity or SBI Blue Chip, right?
Yeah.
Okay. Hope you've taken note of the chops and changes that have been made into your portfolio, as well as how it's really important to have a bit of diversification as well. It only minimizes your risk, Chandrika. Well, we have another query coming in, and this is on our platform Invol, and this has been sent in to us by Chandra, saying investing in property isn't promising in the Delhi NCR region. What are the other options that I can look at, and as of now, with the way property prices are trending, what exactly, Poonam, is it that you would be advising? How can one look to get better returns, and what's your outlook in terms of pricing, particularly in Delhi NCR?
Not only Delhi NCR, but across country, or as an asset class in the real estate, I don't see very, very good promising returns as an investment. So investment should not be the primary target when you are buying a property now. From now onwards, you should look investment in different other categories rather than real estate. Real estate should be bought only if you need it for consumption. For if you want to stay, if you want to buy a house for your own, you should definitely buy a property because the prices are very promising. But if you're expecting good returns, because normally in the past the property was bought for capital appreciation as well as good rental income and so on and so forth, which may not look very nice right now. So instead of going into real estate, which locks your money also for a long time, and capital appreciation are not very promising in the future, you must look at different other options for investment, like a mutual fund, which can be a core investment avenue where you get all kind of different assets under mutual fund category, which have more liquidity and more returns.
All right, we've got a caller who's called us with us today. Vijay Kumar from Bengaluru is on the phone line. Hi Vijay, thanks so much for calling in. Tell us, what's your question?
I am investing Kotak Select Focus Fund 4,000 every month.
Right, go ahead.
And Sundaram Select Focus Fund 4,000 every month since from 3 years.
Okay.
Time horizon is more than 15 years. Whether I should continue in the same funds or I have to shift.
All right. So Poonam, he is investing in Sundaram Select Focus Fund 4,000 a month and Kotak Select Focus Fund 4,000 again. Wants to know what the future, his time horizon is 15 years, and whether he should continue or sell.
See, both the funds are very good and they've been performing very well. They are of the top category funds in the large cap categories. Again, what we were talking about, the diversification is not proper. 15 years is a very good time horizon. You should look for more riskier, aggressive funds to get better returns of the markets. For example, if you are a conservative investor, continue in one of the funds. Both are very good in the large cap category. But for the second SIP, you choose a more aggressive fund of a mid cap category. For example, you can go for L&T Emerging Businesses Fund, or maybe of Sundaram Select Mid Cap of the same fund house. You can switch to Sundaram Select Mid Cap. Together, both the large cap and one mid cap together will give you better returns in a 15 years horizon.
Okay, I hope you were able to get that question answered and you've got a good long time horizon in mind. Hope you've taken the advice of Poonam and Vijay Kumar. Your question has been addressed. Thank you so much, Poonam, for joining in today in our studios. Yes, we do take on all those live queries, but a special coming up tomorrow on credit card and debit card fraud, how you can protect yourself. So tune in tomorrow at 5:30 p.m.